For the first time since the pandemic hit in 2020, the Federal Reserve has lowered interest rates. But why now? And what does this 0.5% decrease mean for your wallet? Over the next few minutes, I'm going to break down what's going on with interest rates, why it matters, and most importantly, how it's going to affect you. We're going to cover what the Federal Reserve does, why they suddenly reverse course on their interest rate increases, and the key ways that this change impacts your life. So, whether you're looking to borrow, save, or invest, this is news that you need to understand. Let's dive in and make sense of the Federal Reserve's latest moves. So, what is the Federal Reserve? The Federal Reserve, or Fed for short, is the central bank of the United States and one of the main central banks around the world. And the Fed has two main jobs. Their job is to manage inflation and keep your dollar's buying power steady. Their second job is maintaining maximum employment, which is basically ensuring that the unemployment stays as low as possible. So the Fed has those two jobs, but how do they actually get those jobs done? How do they accomplish that? The Fed uses what's called monetary policy, which is different than fiscal policy. Fiscal policy is set by lawmakers and Congress. Monetary policy is done just by the Federal Reserve. And monetary policy is the Fed's way of controlling inflation and unemployment by adjusting what's called the federal funds rate, their main tool in their arsenal. The federal funds rate is the rate that banks charge to each other for overnight loans. Now, even though the federal funds rate is between banks and their overnight lending, the effects of adjusting the federal funds rate are felt all the way down the economic line to you. So, if the Fed increases the federal funds rate, this means that the cost to borrow is going to increase, and thus economic activity is going to slow down. If the Fed decides to lower the federal funds rate, this means the cost to borrow has gone down, and thus we'll see an increase in economic activity. By adjusting the federal funds rate up or down, the Federal Reserve has the ability to heat up or cool down the economy as they see fit. Now that we understand what the Federal Reserve does and how it does that, we can now understand why rates were so high to begin with. In short, it's because of the COVID-19 pandemic. You see, when COVID happened, there were lockdowns, economic activity slowed, and to make sure the economy was still functioning and kept moving, the government gave out stimulus checks and also provided PPP loans to businesses. This kept the economy moving by putting dollars into the system and allowing business to transact. But an unintended consequence of that is too much money in the system means that there's too many dollars chasing too few goods or services. And so prices increase. And that's why we saw inflation. And we not only saw inflation, but we saw the pace of inflation increase at a pace faster than we've seen before. Now, the Fed's response to seeing this increased inflation was to increase the federal funds rate to get money out of the system and to cool down an overheating economy. So rates went from nearly zero to about 5.25% in the span of just about 18 months. These are the highest rates that we've seen in about 22 years, and also the fastest pace of rate increases that we've seen in history. So, what does this mean for you? These increased interest rates, while trying to cool down the economy, had the effect of increasing things like mortgage rates and car loan rates, which meant that your monthly payments would be a lot higher because the cost to borrow has gone up. On the flip side, though, it did provide an opportunity for people to get higher interest on things like their high yield savings accounts and their CDs, save places to park money while earning some good interest. So the Federal Reserve increased interest rates to handle an overheating economy and to tackle inflation. Why now did they recently just decide to cut rates? Two big reasons. Number one is that the economy is starting to cool. Consumer spending, business investment, and manufacturing are all slowing down. And number two is the rate of inflation is slowing down considerably. Prices are starting to stabilize, and the rate or pace of inflation is slowing down considerably. So the Federal Reserve saw this data of a cooling economy and decided to lower interest rates. Their main fear was that the economy would cool too much and would cause a recession. Okay, so we discussed the Federal Reserve, what it does, how it does it. We discussed the rate increases since the COVID pandemic and then the recent rate cut. But you're probably wondering, what does this all mean for me? Well, the good news is borrowing is most likely going to get cheaper. As we discussed, the Federal Reserve lowering the federal funds rate means that borrowing costs are going down, not just for those banks, but for everyone else down the economic line. So if you're in the market for a new home or a new car, you should hopefully be able to see lower monthly payments due to lower borrowing costs. And secondly, the stock market may end up doing really well because of this. You see, historically, when interest rates come down, the stock market does well because more money flows in, searching for higher returns. Hopefully, that means higher balances in your retirement accounts and any other investments that you own. Now, on the flip side, that also means that the interest rate that you may be getting in your CDs and your high yield savings accounts is most likely going to come down. I just checked mine, my high yield savings account, and I did see that the interest rate had dropped about 0.2%. Some benefits, some downsides, but here's some things I want you to consider as well. Now that the cost of borrowing has gone down, this may be a good opportunity for you to review your loans and look for opportunities to refinance, bring those borrowing costs lower, and hopefully reduce your monthly payments. I would also recommend checking your investment mix to make sure that it's an appropriate allocation for your goals, but also that you're positioned well to take advantage of a lower interest rate environment. And this may also provide opportunities for you to shop around for better interest rates now that interest rates have gone down for everyone. Hopefully, this means your financing costs can come down considerably. So, a quick recap here, we discussed the Federal Reserve's decision to lower interest rates by 0.5%, their first rate cut since 2020, which means it's good for borrowers, less good for savers in the high yield savings accounts and CDs. And lastly, the Federal Reserve made this decision because they wanted to make sure that there was continued economic growth without the fear of recession. Lowering interest rates helps to do that, helps to free up economic activity, and hopefully we can continue to see good growth going forward. I hope that this breakdown of the Federal Reserve's recent interest rate cut helps you better understand the economic consequences of that decision and how it's ultimately going to affect you. Whether you're looking to borrow, save, or invest, the changes that are going on within the economy do have an effect on you down the line. And they're going to affect your financial decisions in the coming months and years. If you found this video valuable, please don't forget to hit the like button and don't forget to subscribe for more educational content on the financial system and how to use the system to your advantage. Until next time, this is Sid Misra, Certified Financial Planner. Thank you so much for tuning in. Take care. I'll see you soon.